The middle class was once built on a simple promise. Work hard, save responsibly, avoid excess, and you would live a stable life and gradually build wealth. That promise is now breaking. Not because people stopped working, but because the financial system itself has turned against them. Today, the middle class is being slowly ripped apart by the very institutions that once claimed to protect it. The betrayal begins with savings. Banks encourage responsibility. They tell people to save for emergencies, for retirement, for their children's future. Yet the interest they pay on those savings is barely noticeable. In many cases, it does not even keep pace with inflation. This means that responsible savers are losing purchasing power every year simply by trusting their money to the banking system. Caution is punished. Patience is punished. At the same time, those same financial institutions charge brutally high interest on debt. Credit card rates often exceed 20 or even 30%. A family that falls behind because of a medical emergency, car repair, or job disruption can quickly enter a debt spiral that is mathematically stacked against them. The balance grows faster than payments can contain. One missed payment triggers higher rates. The bank profits endlessly while the borrower drowns. Then come the fees, NSF charges, overdraft penalties, late fees, transfer fees, maintenance fees, processing charges. Small mistakes often, just timing issues between paychecks and payments, can trigger multiple penalties on the same day. A momentary gap becomes a financial avalanche. This is not protection. This is extraction. Credit cards, once marketed as tools of convenience, have become survival tools for millions of middle-class families. With wages lagging behind rising living costs, people are forced to rely on plastic to cover groceries, fuel, utilities, and emergencies. But borrowing is no longer neutral. It is predatory by design. Interest ensures that temporary hardship becomes permanent struggle. Many people are no longer paying for what they bought, they are paying for interest alone. So-called good debt has also turned toxic. Mortgages, student loans, and auto loans were once seen as pathways to security. Today they often become lifelong chains. Student loan balances grow far beyond what people originally borrowed. Mortgage payments jump as rates rise. Car loans stretch longer while vehicle prices climb higher. People are not living extravagantly, they are simply being priced out of normal life. Even when people try to escape, the rules shift against them. Credit scores punish those who reduce borrowing. Collections follow people for years. Bankruptcy damages opportunity for decades. The system is built so that escape is always harder than entrapment. Banks profit when you save almost nothing. They profit when you borrow heavily. They profit when you fall behind. They profit when you struggle to recover. This structure is not accidental. Modern financial institutions make enormous profits not from helping people build wealth, but from keeping people trapped in cycles of dependency, fees, and compounding interest. The middle class is no longer their customer. It is their product. Inflation quietly amplifies the damage. Food costs rise. Rent rises, insurance rises, healthcare rises, education rises. But wages crawl forward slowly while debt compounds exponentially. The middle class is squeezed from both directions, prices crushing from above and interest choking from below. The psychological toll is severe. Financial insecurity reshapes how people live. They postpone families. They delay healthcare. They give up long-term plans and focus only on survival. Stress becomes permanent. Burnout becomes normal. Hope becomes fragile. What makes this situation even more dangerous is that financial institutions are protected in ways ordinary people are not. When banks make reckless decisions, they receive support. When ordinary people fall behind, they face penalties. Losses are socialized for institutions and privatized for individuals. This imbalance fuels resentment, distrust, and rising social tension. The middle class is not collapsing because people lack discipline. It is collapsing because the rules of the system were quietly rewritten. Savings stopped rewarding responsibility. Debt became a profit engine. Fees multiplied. Risk moved downward. Wealth flowed upward. This is not a failure of character. It is a failure of financial design. A shrinking middle class weakens everything: homeownership, entrepreneurship, family stability, consumer spending, and social trust. The same institutions profiting today from interest and fees may face a far deeper crisis tomorrow when the economic foundation beneath them finally cracks. The middle class is not being destroyed by a sudden catastrophe. It is being dismantled slowly, steadily, and by design.